Hello, we are Team Icon Shoes. I'm Katie and this is Laura. This is our final debriefing on what we learned throughout the 10 years that we ran our company.
Okay, so the highlights, our biggest success here was year 11. Our celebrity backing, we managed to sign Oprah, which was our goal, and she helped us a lot. Our biggest failure in year 11 was production. We underestimated our sales and ended up with a major shortage.
Okay, so biggest success for year 12 was our production. In year 1, in 1 year, we managed to get our production under control, and we no longer had those huge shortages, and we also didn't have a lot of a surplus, but enough that we had a little bit of cushion. And our biggest failure in year 12 was our private label market. We had 3 regions where we bid a private label shoe, but we ended up having 0% market share, so all those shoes went to our inventory, which added extra cost for us.
Okay, year 13, our biggest success was our internet market share, which was much higher than expected, ranging from 14 to 18%. And our biggest failure was our advertising. We were spending marginally less than our competitors.
Okay, so biggest success for year 14 was our place in the game. So we had been on a steady decline up until year 14, so we started out at like 7th place and we were slowly moving towards like 9th place. But in year 14, we jumped at least 20 points to get us up in the game, and it was one of the years where we were at our highest in the entire game. Our biggest failure in year 14 was once again production, so we got really upset because we had that all under control, and unfortunately we underestimated the popularity of our shoes and ended up with major shortages, which really hurt our reputability.
Okay, year 15, our success was their advertising. For the first time, advertising was a strength for Team Icon, and our biggest failure was production again. We had a shortage.
Okay, so year 16, getting closer to the end, our biggest success was our internet market share, so it was way above our goal of what we had predicted that it would be. However, our biggest failure was our branded market share. We were way below what our goal had been planned for year 16.
Highlights from year 17, our biggest success was our financial markers, such as our return on investment, which was 39%, and our earnings per share, which was $5.45, and our stock price, which was 82. That was really awesome, and our failure was our celebrity appeal because we had lost multiple contracts.
Okay, so for year 18, our biggest success was our private label market share, so we decided to re-enter into the private label. We had exited before, one, because we were doing really bad, but also it was over flooded, so a lot of competitors were trying to sell their shoes and there wasn't as big of a demand. But we re-entered in year 18 and we ended up with outstanding numbers. Overall, our market share was right around 19%, 32% in North America though, as a really big high for us there. However, our biggest failure was our celebrity appeal. We lost all of our remaining celebrities. We were outbid on all of those, and that was something that we were really trying to keep for Team Icon. So that was a failure for us.
Year 19, our biggest success was our private label. Again, like Katie said, we entered back into the market when originally it was a downfall for us, and this second time around ended up being really great because a lot of other companies had exited that market. So we were able to get a bigger market share. Also, the Chinese companies had left at that time.
Yeah.
So that helped us as well. Our biggest failure was our branded market share, which went down that year.
It was very low. It was sad. So year 20, our biggest success in year 20 was again our private label. So for the last 3 years, we were really excited that we went back into the private label market because it did do wonders for us. However, our biggest failure was our internet market share. So we were sitting right around like a 4% market share in all the regions, and that was way, way below what we wanted to be. So we kind of bottomed out in year 20 for the internet market share.
Okay, our original vision and mission statements. Our company vision was equipping the world with affordable, quality, and in-style products. And our company mission statement was to create, design, and provide affordable, quality footwear and products that promote proper structural foot support. We provide our workers with fair wages, honor, and encouragement. We strive to continue our brand recognition through several lifetimes. Icon shoes are as smart, sexy, and confident as the people who wear them. The fashionable folks who choose to live life like an icon.
So as she said, that was what our original mission and vision was. Throughout the years, Icon made a lot of changes, so we had to adapt our vision and mission statement. So this is what our first adaptation gave us, and this is when we went from high quality, low models to the exact opposite. Actually, we changed to high models, low quality. So we needed to change a few things in our vision and mission that kind of got rid of that high quality aspect. So our new vision was equipping the world with a wide array of affordable and in-style products. And our mission was to create, design, and provide affordable footwear and products that promote proper structural foot support. We provide our workers with fair wages, honor, and encouragement, and we strive to continue our brand recognition through several lifetimes. Icon shoes are smart, sexy, and confident as the people who wear them, the everyday folks who choose to live life like an icon.
Okay, the final version of all that in our company vision was equipping the world with comfortable, affordable, and in-style shoes. Our mission statement is to create, design, and provide affordable footwear and products that promote proper structural foot support, provide our workers with fair wages, honor, and encouragement. We strive to continue our brand recognition through several lifetimes. Icon shoes are as smart, sexy, and confident as the people who wear them, the everyday folks who choose to live life like an icon.
Okay, so this is just a little bit of our organizational chart just to get to know the company. We originally started out with 4 major managers throughout the company, Laura Mikulski, Caitlin Nagel, Daniel Zima, and Anna Cusmano. As you can see, Daniel Zima and Anna Cusmano are no longer with the company. They did resign, so all of the responsibilities kind of got left on the 2 of us. So Laura Mikulski, she is our marketing VP and our vice president of logistics and operations. So some of her responsibilities included she was a co-manager of Team Icon. We decided to be co-managers after the split happened. She was our creativity management, marketing, advertising. She helped us figure out a spending allocation for those, and also our distribution management. So she really took over where we distributed our products, how many shoes we were going to distribute to each region, and how we were going to get them there. Me as myself, I was CEO and CFO of the company, so again, co-manager of Team Icon. So I was the coordinator. I made a lot of financial decisions, such as our stocks and dividends, pricing, celebrity bids, how much we were allocating for each of those things. So besides the marketing aspect that was set on Laura, I was basically all the other financials. And also I was just a coordinator, so every time we needed to meet, every time we needed to make decisions, I set up to make sure that we could cooperatively both meet at the same time. So that was kind of one of my responsibilities.
This is our Team Icon mind map, and what you'll see in this design that we have is that we didn't want to split up the responsibilities because we felt like everybody had something to add to the table for every different area. So basically we have on here when different strategic plans were due, when this is our practice round over here, and when the different decisions were made, and then also our goals, our SWOT analysis, and what meeting times worked for everyone. And then there's all our names in the middle, and we're all kind of a part of the big puzzle.
Okay, so now we're going to break down our 3 strategic plans for you. So every 3 years we had to come up with a new strategic plan that kind of guided our company on where we wanted to go. And if we were struggling in a year, we would come back to our strategic plans to see what did we not achieve, like what were we not focused on, and hopefully back that area back up to where it needed to be. So some strategic plan 1 for year 11, 12, and 13. Our key business objectives and strategy. For year 11, it was to attain celebrity backing, build capacity. We wanted high quality, low model, and we wanted to achieve a 6-star rating in all 4 regions. So those were some of the goals that we had set ourselves, and then at the end of year 11, we looked and were like, did we achieve these? And we made adjustments based on that. Year 12, our only new strategic objective was to raise our SQ rating by a star. So we wanted to maintain all of the ones from the previous year, but we also wanted to get us up to a 7-star rating. Again, year 13, we had planned on raising our SQ rating again. raising our market share by 3%, building capacity in Asia Pacific, and raise the percentage of superior materials used. We also wanted to give an incentive to our Asia Pacific plant to hopefully boost it to cut the rejection rate down.
Okay, continuing on our strategic plan 1 for years 11, 12, and 13, our key function strategies for production in year 11, we had 4,050 pairs per worker in the US and 2,518 pairs per worker in Asia. And in year 12, we built capacity in Asia Pacific plant, which equaled to 300,000 pairs, which was a big improvement in our production. And then in year 13, we increased our number of models from 150 to 200, and we increased the number of models available online to 95.
Okay, so some more areas that were kind of more broken down apart from our overall strategic goal was marketing. So we kind of wanted to lay out what we were planning on doing in advertising just for years 11, 12, and 13 for our first strategic plan. That's where we really wanted to focus. So as you can see, we decided to, for year 11, we were goaling $10 million advertising in North America, $8.5 million in Europe, and then $5 million in both Latin America and Asia Pacific. And then for year 12, we wanted to raise everything, so $14 million in North America, $10 million in Europe, Asia, $6 million in Asia Pacific, and $7.5 million in Latin America. And then for year 13, just depending on what our success rate was going, we plan to raise advertising $1 million in each of the segments.
Okay, continuing on again for strategic plan 1 in year 11, 12, and 13. Key function strategies for finance. For year 11, we had a $100 million 5-year loan, which was used to build capacity in the North America plants. We raised our dividends in year 12, and in year 13, we considered charitable contributions of $1 million. And with our human resources in year 11, we offered ethics training, full capacity US and Asia. So that was when we were working overtime. There was 350,000 hours in overtime in the US and 600,000 hours in overtime in Asia. Year 12, we offered a workplace diversity program. And in year 13, we had a raise in wages and also in our overtime.
Okay, so this is some market share objectives that we had set out at the beginning of year 11, kind of what we wanted to see from years 11, 12, and 13. So for private label, we wanted a 15% market share in year 11, staying with that 50% in year 12, and then raising to a 17% in year 13. For internet, we wanted to see a 20% market share for years 11 and 12, and then raise to 25 in year 13. Brand and market, break it down by region. North America, we were looking for 14% in year 11, 15 in year 12, and 17 in year 13. And for Europe, we were looking for a 10% in year 11, 12% in year 12, and 13% in year 13. Latin America was the same as Europe, and so was Asia. So Europe, Latin America, Asia, we're hoping to see like a similarities between the three. For our overall market share, we were hoping for a 25% in year 11, 25 in year 12, and 27 in year 13. So that was kind of our bold goal for those 3 years at the beginning of year 11. That's what we were hoping to make.
Well, you can't blame us for aiming high.
Nope.
Our primary target markets in the private label, our primary target markets, number 1 is North America, 2 Europe, 3 the internet, 4 Asia, 5 private label market, and 6 Latin America. And I think that was a pretty good plan.
Yeah, we kind of stuck to that. That's kind of how we focused all of our advertising and pricing and all those strategies that went into it. We really focused on getting our top 3 as high as possible, and then 4, 5, and 6 we wanted to come in a little bit low. We expected to come in a little bit lower because we weren't putting as much emphasis on those 3 areas. Okay, so moving on to our strategic plan 2 for years 14, 15, and 16. Our main objectives and strategies, year 14 was to re-sign Oprah, but hopefully at a much lower price. Our first time around, we spent $15 million a year on her, and we wanted to cut that down because we felt like that was too much to be spending. We also wanted to raise our models, so we wanted to have like a high model, so we wanted to raise it above 200 and lower our SQ rating. With that lower SQ rating, we needed to cut down on the superior materials used, so we were looking for a different strategic plan. We had switched from that high model, or that high quality low model, to a high model low quality, to see if that would work out better for us. Year 15, we wanted to again raise models and lower SQ, and then build capacity if we felt that it was necessary. So that was something that we were going to analyze at that time to see if we needed to. And then in year 16, we wanted to again raise our models and give us an incentive boost in some of our regions, just to help give them a reason to want to work for us.
Okay, continuing on the strategic plan 2, 14, 15, and 16. Key function strategies in production were 4,040 pairs per worker in the US, so that didn't really change. 2,457 pairs per worker in Asia. In year 15, we wanted to increase overtime and purchase capacity if necessary, and then the same thing with year 16, increase overtime and purchase capacity if necessary.
Okay, so moving on to marketing. For year 14, we rebid on Oprah as a celebrity for our company. That was something that we wanted to do at a much lower price than the first time, and it actually worked out for us. We did end up getting Oprah, so we were really pleased with that. For advertising expenditures, we decided to go with $10,406,000 in North America, $7,727,000 in Europe, $6,922,000 in Asia, and about $6.9 million in advertising for Latin America, with our rebate at $2. So before, we hadn't really talked or discussed about what we would set our rebate at, and this is what we were kind of goaling for, to see how that would work out for us. Year 15, we raised our advertising in North America to $12 million, $10 million in Europe, $7.9 million in Asia, and $8 million in Latin America. And we wanted, for year 16, to maintain a high advertising amount in North America and Europe, Africa. We really wanted to bid on some more celebrities and raise advertising in relation to how many celebrities we had gotten from previous years, just try to keep a good correlation between those.
Strategic plan 2, continuing on. Key function strategies in finance, we paid out for loan, and we increased our sales of stock. Year 15, we increased our dividends and increased our credit rating. Year 16, raised dividends and repurchased stock, which ended up being a bad idea. I mean, it was good because it raised our stock value, but then we didn't have a lot of money.
Yeah. Year 14, it helped a lot, but we should have stopped at year 14 on repurchasing.
Yeah. Human resources, again with the ethics training, full capacity in US with 460,000 hours in overtime, and in Asia, 880,000 hours overtime. Ethics training for 15 and 16, 350,000 overtime for both years, and 600,000 overtime in Asia for both years.
Okay, so back to market share objectives. Like we had said, we exited out of the private label market, so of course we were putting that at a 0% market share. We weren't expecting to get any because we weren't operating. That makes sense. Our internet was supposed to be, we wanted a 10% share across the board. For our branded markets, North America, for years 14, we were looking at 10% and then raising it by 2% each year. Same thing in all of our regions, we were looking to raise it 2% each year. Europe started out at 6%, Latin America and Asia both started out at 8% market share. So our overall market shares we were looking for was 6% in year 14, 8% in year 15, and 12% in year 16.
Our primary target markets, Europe ended up being our number 1, followed by the internet, then North America, then Asia, then Latin America, and private label was last, which I guess could have really just been off the charts because we weren't doing it. So we did switch it up some.
Okay, so some of our, moving on to strategic plan 3, 17, 18, and 19 were the years for that. Some of our key business objectives and strategies. Year 17, we wanted to re-sign Oprah and 1 or 2 other celebrities. lower our SQ ratings. So we were going for low SQ, low models. The other market that we were competing in had just gotten too competitive, and we wanted to try to differentiate ourselves. Unfortunately, we didn't really achieve many of our key objectives because we did not manage to re-sign any celebrities, and we did achieve the low SQ, low models, but it might not have been the best way to go because we did lose a lot of money on it. But anyways, for year 18, we wanted to lower the models, lower the SQ, and build capacity if necessary. And year 19, we were really looking to like steady everything out, so keep a low model, low SQ, but not necessarily lower it anymore. And then, if necessary, give an incentive boost to either Asia Pacific or North America, just to try to help us out some.
Okay, our key function strategies in production for year 17. Again, the 4,040 pairs for the US and the 2,457 pairs for Asia. In year 18, we wanted to re-enter the private label market, which again worked out well for us. And in year 19, we wanted to increase our overtime to produce in the private label market.
Okay, so marketing. Year 17, we wanted to advertise 14 million in North America, 13 million in Europe, Africa, 10 million in Asia Pacific, and 7 million in Latin America, and set our rebate at $1. Advertising in year 18, 5.5 million in North America, 14 million in Europe, Africa, and 12 million in Asia Pacific, 9 million in Latin America, and again, rebate at $1. And then year 19, we wanted to kind of stick with those numbers. We thought that was a good place to stop. So at the time, at year 17, that's what we thought we would end up being.
Okay, our key function strategies in finance, year 17, we had no dividend and no issue of stock. In year 18, we repurchased our stock and we were considering a loan. In year 19, we did repurchase some more stock. Our human resources, in year 17, we had the ethics training, 460,000 hours of overtime in the US, and 880,000 hours of overtime in Asia. In year 18, the numbers dropped for both regions. In the US, it was 350,000 overtime, and in Asia, 600,000 overtime. And in year 19, we added that incentive boost in Asia.
Okay, so market share objectives. When we had first made our market share objectives at the beginning of year 17, we weren't anticipating entering back into the private label market. So we had set that at 0% because we thought we were going to stay out of it. And then due to factors that came up during after year 17, that's when we decided to re-enter it. We thought it would be a good idea. So our strategic plan doesn't really reflect what we ended up doing. But we thought 0% across the board. Internet segment was sitting at about anywhere from 8 to 9% for years 17, 18, and 19. North America, we wanted an 8.3%, 8.7%, 9.4% for the 3 years. In Europe, we were thinking 6%, 8%, 9.2%. Latin America, 6.5%, 7.3%, and 8%. And Asia, we were thinking 6.5%, 7.4%, and 8%. So as you can see, by the time the project ended, the years were coming to a close, we were a lot more realistic about our market share percentages. Before we were thinking like 20%, and now we were more realistically going with an even share, more like around 10%. So we felt like that was probably a better way to go. We were a little more realistic, a little more grounded.
Okay, our primary target markets for that time period, again, it was what? Stay the same. Okay, everything's the same. Europe is at 1, the internet is at 2, North America 3, Asia 4, Latin America 5, and our private label 6.
Okay, so this was our exit plan for year 20. So this was kind of what we thought we were going to try to do at least for year 20. We wanted a private label market share of 50% across the board, the overall, not in each region. We requested a line of credit from the government after year 19. We took a big hit in year 18. We repurchased too much stock. We made some risky decisions that financially hit us hard, so we requested a line of credit from the government, and we chose to use that to invest in advertising. and incentives for people to buy our shoes. So for North America, we invested $20 million. Europe, Africa was $21 million. Asia Pacific was 17, and Latin America was 16 million. And then we wanted our rebate offers at about $5 per region. So it wasn't set, but we wanted it to be average, about $5 per region. We planned to issue no more stock, but we wanted to start issuing a dividend again. So we hadn't been issuing, and we decided to go between $1 and $2. And continue our ethics training with employees and utilize remaining capacity to produce in the private label. So we really wanted to continue to work on our human resources. That's been a strength for Team Icon throughout the entire competition. We really want to make sure that our employees are treated fairly. So that's something that we stayed steady with throughout all of our changes that we did make.
The exit plan on where we wanted to be percentage-wise in the different regions. For the private label, we wanted to be at about 20%, Internet 10%, North America 10%, Europe 10%, Latin America 7%, and Asia 7.5%. And we wanted an overall market share of around 8.625%.
Okay, so just to explain what we thought some of our risks were going into year 20, mostly they included profits and market share. So the market that we were trying to operate in was not a highly profitable market just because it was a low quality, low bottle. So we weren't offering a ton of variety for the customer, and we weren't offering quality for the customer. So we were just trying to differentiate ourselves, but it wasn't a super profitable market. So the problem is there wasn't a high traffic presence with that, so that was a risk that we had. So we ran the risk of losing not only profits but market share in general because other companies were offering more incentives than we were.
Okay, Icon Shoes. Icon Shoes has been managed from year 11 to year 15 by Laura Mikulski, Daniel Zima, Caitlin Nagel, and Anna Kuzmano. In year 16, Daniel and Anna left. And up until that point, we were having many issues, and the split was a positive. Very true.
Okay, so we did a SWOT analysis of our team in general, not so much of our company, but as how we work together. So some of our strengths when we had all four of us was that we had a diverse background, we had good planning skills, good communication, and leadership was strong suit for most of the people in it. The problem was that we had a lot of headstrong people, conflicting ideas, and controversy. So it wasn't that we weren't getting along, it was just there was too many people who had so many ideas, and it was just throwing it all together, and we weren't working well as a team. So opportunities that we had is because we had all these different ideas, we had the opportunity to test the ideas and see which ones worked the best. We had outside thinkings, but our threats were we had fighting among our teammates, which was making it hard to come to a conclusion. The cohesion among other teams was really a threat to us because we weren't working well together. Their cohesion was a threat that they were working well and they could come up with ideas more quickly and think on their toes a little bit better than we could. And some of the other teams had a better way of analyzing data. So they were analyzing things quickly, making changes quickly, making smart decisions, and we were just had so many ideas coming from all the different directions, and we were getting lost in all of these ideas.
Successes. Our private label for year 18 through 20 was very good. Our celebrity appeal, because we had Oprah and other celebrities, went over very well. We offered free shipping. Our delivery time for most years was very low. And our stock price was good, and our return on investment and our earnings per share for year 16 through 18 were very good.
So some of our failures, productions, for several years we had shortages, so that was something that we really needed to work on and probably should have invested some more time in it to make sure that that didn't happen. Our private label for years 11 and 12 was a big failure for us, so where it was a success for us later on, it was awful for us in the first couple of years, and it was kind of detrimental to our team. It really hurt us in the marketplace. For years 11 through 14, our financial markers like return on equity, earning per share, and stock price were tanking. So they were very, very low, very, very under from what all of the other teams were hitting. So we were not doing so well there. So again, where it was a failure for or success for us later on in the simulation At the beginning, it wasn't, and I think that really is what hurt us the most, is we didn't start off as strong as other companies did. And then our market share in years 18 through 20, so where we were doing good in the private label, we whomped big time in our wholesale marketing and even our internet towards the end.
Marketplace. Our marketplace was very competitive. Some changes were that most of the competition was opting for a high-quality, low-model strategy in the beginning, but as not everyone can pursue this type of strategy, the competition started to rise. Strategies were changed and implemented to try to beat each other out, and the economy went through recessions.
Yeah, so we had some like curveballs thrown at us with other companies, and it just kind of threw us off our game a little bit, so I think that also kind of hurt us. But some strategy changes that ICON went through. So in 10 years, as you can see through our strategic plans, ICON went through some major changes. So between the years of 12 and 13 it was when our first big changes happened. We made a few changes between 11 and 12, but 12 and 13 is when we started making those major decisions. So we went from high quality low model to low quality high model. We increased our advertising budget, increased our retailer support. We decided not to cancel our celebrity backing, and we exited the private label market. So those were all things that like completely turned the company upside down, and we had to regroup and hopefully make these new changes work.
More strategy changes. ICON went through major changes through the 10 years. Between 15 and 16, we switched to low model fields to differentiate from the competition. And we took out an $80 million 10-year loan to repurchase some of our stock, and we added more celebrities than just one.
Okay, so explanation of our exit strategy. So it was based on our issues that we had in year 18. So a lot of stuff that we had decided to do was because we had done so badly in year 18. We took a big hit financially, which caused us to have to ask the government for a line of credit. So we used that line of credit because to pay off our loan and invest in advertising. We also were looking to expand our private label market share, since that was something that we were doing really good in. We figured, let's hone everything we can into that private label and keep it going and keep it expanding. So that was kind of our thinking behind our exit strategy.
Okay, this is my reflection. I'm going to read you this and then I'll kind of expand on it after. Lots of changes happened. It was me that presented the group, pressed the group to split because I thought it was for the best, and it was. We learned a lot, and we saw what worked better together and what was better when we separated. Team ICON survived through it all, the Chinese companies, the recession, and all the ups and downs, and I think we did okay. Where we could do better, I think, was that we shouldn't have sold so much stock, bought so much stock back, and we should have never made it, and we never made it above 5th place, which is unfortunate. So we were not the best company, but we weren't the worst either. So what I think I did good personally is that I think I was more of a risk taker. Like, I think the group might have split eventually, but they were kind of going back and forth, like, oh, I don't know if we should, I don't know if we want to. So I think I did good by saying, okay, I really think we need to split up, just because specifically Dan and Katie were really strong leaders and they kept bumping heads so much, and Anna and I were kind of going with the flow, but Anna kind of favored Dan's decisions and I kind of favored Katie's decisions. And then also, I went with a consultant, which I don't think Dan would have done, because Dan was very big on coming up with everything himself, and he wanted to be very proud of his decisions, which is why I think him and Katie bumped heads so much, is he wanted his decisions, whether they were good or bad, he wanted it for himself.
Yeah.
So that's what I think I did well.
I agree with that. I think she did. I think she was good for me too, even in the split. I'm glad that Laura stuck by me because she was good, like, with calming me down. Like, like she said, I was nervous about the split. I didn't know how that was going to go over so well. And she was really good at, like, reassuring me, like, we have good decisions, like, it's going to turn out how it turns out. And I'm really glad that she pushed the split.
Okay.
So my reflection, I think Team ICON went through many changes, so we ended up splitting, and like I said, I was nervous about it, but it turned out to be really good. I was a lot less stressed afterwards. There was just too many leaders in our group, and the ideas were far too opposing, so it ended up being for the best, and Laura and I ended up working really well together. We made decisions together, some good, some bad, but it was collaborative. It wasn't like I was making all the decisions or she was making all the decisions. We were making them together, and we celebrated our victories together and mourned our failures together. It wasn't anybody's fault. It wasn't anybody's one person's blame. So that kind of worked out really well. I think the most important thing that I learned was that saying that my dad tells me all the time, that's too many cooks in the kitchen spoils the food, is 100% true. So I have great respect for all my 3 coworkers that I had during the project, but we were just too different, and the split I think helped both groups. I think that Dan and Anna did a really good job on their own, and they were a lot happier and we were a lot happier. So I think that whole saying that too many cooks in the kitchen spoils the food is 100% true, and that's probably the thing that I learned the most about this class. So that's it for our debriefing. Thank you for joining us along this 10-year journey, 10-week journey. You know, it's been kind of crazy, it's been kind of hectic, but it was a lot of fun, and I think we learned a lot from that.
Thank you.